Desjardins joining us in studio, Chief Economist at Deloitte Canada. Don, it's great to have you with us. So a loss of jobs in last month's data. What's your reaction to that?
Well, I don't think it's really all that surprising. People were looking for a slowing in terms of job creation. And when we look at these data, they're survey data, they're volatile, they're all over the place. As we can see, down, up 60, down a little bit. So really, I think what it's saying is that the long-awaited slowing in terms of Canada's labour market is materializing. And we're seeing that, too, in the economy, right? We're seeing slower consumption activity. So I think it all lines up pretty well.
And what do you make of the fact that you see the unemployment rate rising for a third month, obviously job losses during the month, but the wage numbers coming in higher than what was even expected on Bay Street?
Yes, and when we look at a year ago where wages were, it was kind of a tough number to overcome. So it does make sense. It was softer last year, so any modest increase would bump that year-over-year rate. And as we look forward, those comparables are going to switch the other way. So I think quite likely it doesn't signal a reacceleration in wages. I think it's more of a math thing than actually upward pressure on wages.
So are you anticipating, just based on the data, which, as you noted, can be volatile month to month in Canada, that a trend here is forming that might ultimately lead the Bank of Canada at its next interest rate decision meeting to say, well, probably the prudent path right now is to at least do nothing, to not make a move on interest rates, even though inflation has been problematic?
Yeah, I do. I do think that this really bolsters the case for the bank to remain on the sidelines. They've been looking for a slowing indication in the economy, whether it's on the labor side or on the spending side. They're starting to see this. And I think at the press conference, the governor was saying they don't want to tighten too much and cause unnecessary pain for Canadians. And so to the extent that these data give them the leeway to stand back and assess the impact of these rate increases on the economy, I think that's the path that they will follow.
All right. For those who are just joining us, we're covering this breaking news on the Canadian economy. 6,400 jobs lost in July. The unemployment rate rising to 5.5%. Don Desjardins joining us here as part of our continuing coverage. The participation rate, which sometimes can be helpful in trying to assess the health of the economy as well, Don, does look like on that front, we did see participation modestly lower, down 0.1 of a percentage point, so 65.6%. Obviously, we've talked a lot about employment growth through the fact that you've got a huge surge in population here. How does that all net out, just the number of people in the workforce right now when we're trying to assess Canada's economy through the jobs market?
Yeah, and I mean, that explains why the unemployment rate ticked up again, the fact that we are seeing rapid population growth. So a lot of those people are coming into the labor force. And when you have employment gains that are slowing, it makes sense that your unemployment rate would go up. And the participation rate does remain high. So I would say overall, it's not like we're in a sharply deteriorating labor market. We still, I would argue, are in a pretty tight labor market condition, easing a little bit, which is, by design. The Bank of Canada wants to see some easing in pressures throughout the economy. And I think that's what's materializing right now.
So I guess on the one hand, we have to watch what happens with job creation. Already this morning, we're hearing from at least one Canadian company that is being pretty cautious on the jobs front. In terms of the amount of hours work, it looks like, at least in the July data, we saw a 0.1% monthly increase, basically 2.1% year over year. But our Bloomberg colleagues suggesting that points to relatively weak economic momentum as we start to get ready for the third quarter. Would you agree with that?
Yeah, I think that's true. And when we look at the momentum in the economy, it has been slowing. Like we think about the first quarter, 3.1% GDP growth. Looks like it's lining up for about 1% in the second quarter. And now the handoff, looking on the softer side. Now, our forecast is that we will see weaker economic activity in the second half of 2023. And again, just as we see the reaction of Canadian consumers and businesses to these higher interest rates. So it is all, in our view, kind of coming together, if you will. All of these factors that, had been a little elusive in terms of a weakening in the economy really now starting to take hold.
One final question on the interest rate outlook from here. So you alluded to the fact that at the next meeting, maybe the prudent path ends up being do nothing. But I think a lot of people are wondering whether the path ahead will involve the need to keep fighting inflation with even potentially more rate hikes, or if the weakening of the economy will justify at some point interest rates coming down. What's your prediction as we start to think a little bit towards the end of the year and even into next year?
Well, certainly some factors on the inflation front are going to remain sticky. So I think in terms of rate cuts, that's probably further down the road. Additional increases, well, if we do see inflation pressures accelerate, if in fact I'm wrong about that wage increase cooling as we go through the months ahead, again, that's something the Bank of Canada is keenly watching. If they see indications that these price pressures are continuing to mount, then they could act again. But as I say, that's not our base case.
Okay, Don.